Equity valuation is the process of estimating the value of a company's equity using analytical models and financial information. The primary objective is to determine a stock's intrinsic value, which represents the value estimated by an informed analyst with complete knowledge of the company's characteristics and future prospects. Investors compare intrinsic value with the market price to identify potentially mispriced securities. Differences between intrinsic value and market price may arise because markets are not perfectly efficient or because analysts use different assumptions and forecasts. Successful investment management often depends on accurately estimating intrinsic value and identifying opportunities where market prices deviate from fundamental value. A key concept in equity valuation is the distinction between going concern value and liquidation value. The going concern assumption states that a company will continue operating indefinitely and generate future cash flows. Most public company valuations are based on this assumption because investors expect firms to remain active businesses. In contrast, liquidation value represents the net proceeds obtained if a company's assets are sold separately and liabilities are settled. Liquidation value becomes more relevant when a firm faces severe financial distress or business failure. Understanding which valuation perspective is appropriate is critical because the selected assumption significantly influences estimated value and investment decisions. Valuation professionals recognize several definitions of value. Fair market value refers to the price at which knowledgeable and willing buyers and sellers would transact under normal conditions. Investment value, however, reflects the value of an asset to a specific buyer and incorporates unique benefits such as operational synergies, cost savings, or strategic advantages. Investment value is particularly relevant in mergers and acquisitions where an acquirer may realize benefits unavailable to other investors. For public equity analysis, fair market value generally serves as the most relevant benchmark because it reflects the expectations of a broad market of investors rather than the circumstances of a single strategic purchaser. Equity valuation has numerous practical applications across the investment industry. Analysts use valuation models for stock selection, portfolio management, and identifying investment opportunities. Valuation also assists in interpreting market expectations, evaluating corporate actions such as mergers and acquisitions, preparing fairness opinions, and supporting planning and consulting engagements. Furthermore, valuation serves as an important communication tool between analysts, investors, and corporate managers. In private business valuation, accurate estimates are essential for transactions, ownership transfers, and strategic decision-making. Because valuation influences capital allocation decisions, it remains one of the most important functions performed by investment professionals. Industry and competitive analysis provide essential inputs to equity valuation. Analysts often use Michael Porter's 5 Forces framework to evaluate industry attractiveness and long-term profitability. The framework examines the threat of new entrants, threat of substitute products, bargaining power of buyers, bargaining power of suppliers, and rivalry among existing competitors. Understanding these forces helps analysts forecast future earnings, growth rates, and competitive advantages. Analysts must also assess the quality of reported earnings by reviewing revenue recognition practices, expense classifications, depreciation assumptions, and off-balance sheet items. Thorough industry and financial analysis improves the reliability of valuation estimates and reduces the risk of analytical errors. Equity valuation approaches are broadly classified as absolute valuation models and relative valuation models. Absolute models estimate intrinsic value directly using discounted cash flows, dividends, or residual income. Relative valuation models compare a company's valuation multiples, such as P/E ratios, with those of comparable firms. Analysts may also use sum of the parts valuation for conglomerates by valuing each business segment separately and aggregating the results. Market prices of diversified firms may trade below this estimated value, creating a conglomerate discount. When selecting a valuation model, analysts should consider company characteristics, data availability, and the purpose of the analysis. Using multiple valuation methods often provides more robust and reliable conclusions.